It's the bond market that dictates where the interest rates will be. And interest rates are so critical to an economy. Interest rates basically determine whether or not consumers are going to go out and borrow. It drives consumer spending behavior. And it also is a really big deal for, obviously, the federal government. The federal government has $36 trillion in debt. Last year in FY24, they spent $1.1 trillion just to pay interest. And interest rates are rising because the bond market is pushing interest rates up. So now you're going to go, oh man, last year was 1.1 trillion we spent on interest. This year could be $1.5 trillion just on interest on the national debt. So what happens? How do bond yields rise and fall? Well, it's based on supply and demand for bonds. And I think about it, if you're the one guy who's willing to buy bonds and everybody's trying to sell you the bond, you're going to take the bond that has the highest yield. That's how bond yields increase very, very suddenly. And that's what we're seeing right now in the marketplace. There's a sudden surge of people selling their bonds and not that many people left over to buy bonds. So it's a major supply and demand imbalance. China owns a couple $1 trillion worth of US government or US agency debt. And so these guys have so much of it. So they could easily sell $100 billion, $200 billion and still have so much of it remaining. But they'd be able to sell enough to move the bond market, drive yields higher, and in doing so, send a message to the Trump administration, say, we can hurt you.